what does the Western slowdown, so to say, does to the appetite for all kinds of M&A within the landscape that we operate in currently?
Neeraj, firstly, thanks for having me on your show.
Pleasure is ours.
Part of the answer is in your question itself, which is slowdown. And I do think that both if you are a seller of a business, or if you're a buyer of the business, or if you're a financier of the business, there are a number of more complex variables you have to assess before you decide as to whether you want to buy or sell a particular business. And therefore, there is a slowdown that is there on broadly M&A transaction activity, not because people do not have a desire to buy or sell, but it's just because they are recalibrating. The buyers are recalibrating what is the value they would like to pay. The sellers are recalibrating whether they are willing to accept valuations which have corrected in the public markets. And financiers are also assessing as to what is the kind of capital structure and leverage they're willing to put on targets, basis which they are comfortable underwriting the risk. So net result of all of this is that transaction flow is there. The number of transactions which are live probably is the highest ever that you can have, but the pace at which things are moving is slow because people are recalibrating.
Okay, so sorry, am I understanding this correctly? You're saying that is a lot of deal making possibility, just that it's happening a lot slower?
Yes, that's correct.
Without a sense of what the timelines could be as well, because they
without
could be very
a sense of what the timelines could be. Absolutely.
Wow. Okay. Great. Okay. That's a good insight. Thanks for that. So, part two of my question, therefore, is in a world which is also likely going to be slightly short of the slosh of liquidity that we've been used to, could that further impact deal-making activity, you think?
Yes and no. It would just mean that when you're looking at financing a particular transaction, you will be more disciplined from the capital structure that you will put together. And equally, it will also mean that there is an opportunity for more equity to be raised in the context of those transactions. Because let's say if you're solving for 100 rupees of total capital, and in a situation where debt was available a lot more freely and cheaply, then maybe you would have put 75 rupees of debt on this and 25 rupees of equity. But today you may put 65 rupees of debt and therefore 35 rupees of equity. So in a way, it is an opportunity for equity as well to figure out how they can assess it, as long as they're comfortable solving for that 100.
Okay. What happens in a scenario like this? You reckon that by and large, valuations would see a bit of a pullback because the market is not so hot?
By and large, I think valuations for transactions should reflect realities around us. The realities around us are that it is a reasonably soft tone. If you look at public market indices, public market valuations, most of the stocks, whether you're looking at Asia, whether you're looking at Southeast Asia, certainly if you're looking at Europe and also looking at US, most of the public market prices are lower, between 5 to 20%. And it just means that valuations therefore have corrected in the public market. Hence, the M&A market cannot be isolated in terms of how they look at valuations.